Every major financial crisis is caused by the banking system, the central bankers and their monetary policies. For example, in 2008, the global financial crisis, oftentimes we hear in the mainstream media that this was caused by the greedy homeowners, who accumulated a lot of real estate by using some ninja mortgages, and that was a result of the global financial crisis. While in reality, this is not true. And in this video, I'm going to cover what actually caused the 2008 financial crisis and how this is different from back then to the current times. And maybe we are heading towards a point where we may be able to see similar crisis in our lifetime. So without further ado, let's dive in. If you are new to my channel, my name is Yasin Nizami and I make these videos to educate my audience about the real estate market in Canada, macroeconomics, financial system, the financial plumbing of this global monetary system. So if you are interested in any of these topics, consider subscribe and let's get back to our topic of the day. I will be naive to consider that the consumers taking extra mortgages will collapse the financial system, the global financial system, because that cannot happen. And what I can tell you that the global financial system was collapsed as a result of the liquidity crisis, and I can explain. So stay tuned till the end of this video. So in order to understand the liquidity crisis, you have to understand the banking system, the banking operations at a high level. So when you deposit some cash into a bank account, so that cash is going to be a liability on their balance sheet. So at a high level, if you look at the bank's balance sheet, you have two components. One is the liabilities and the other component is the assets. So when you deposit some cash into your bank account, that is the liability on their balance sheet, and they have to offset that by having equivalent amount of assets on the other side of the balance sheet, which is the assets column. And those assets could be any type of security. It could be treasury bills, it could be corporate bonds, it could be mortgage-backed securities, or any sort of debt instrument that they can used to offset the cash liabilities on the balance sheet. Each of those banks have some rules to comply with regards to the banking operation, right? And every day they evaluate their cash situation, whether they are in surplus of cash or they're running short of cash. So if they're running short of cash, then they go into the money markets. We call it repo market, and that's how they try to borrow some cash for the temporary basis, typically overnight, and in return they try to sell their assets. And that engagement is somewhat unique because they make this agreement to repurchase those assets at a later time with slightly more price. So that's how the repo market works. So repo market is basically a money market for banks and financial institutes to go out and lend money for temporary basis in return of exchanging their assets. So that's when they run out of cash. If they have more cash, then of course they do the opposite. So they lend that cash to other financial institutes in return of purchasing some assets. Could be, treasury bills, could be corporate bonds, could be mortgage-backed securities, or any sorts of debt instruments. So understand that the repo market is where banks go out and borrow some money in return of exchanging some assets. And the opposite of this is called reverse repo, where the banks actually purchase securities by lending money into the system. So it's basically the system for banks and financial institutes to exchange money with collateral. Okay, so the collateral could be any financial asset and it has to be valuable. So the condition is the collateral that you are trying to exchange with has to have more value than the cash that you are trying to lend. So when you don't have the collateral equivalent to the amount of money that you are trying to borrow, this is where the liquidity crisis begins. In 2008, this is what exactly happened. So Lehman Brothers, who went bankrupt, what happened with them was they did not have enough money to operate themselves. Okay, what they did was they went into the repo market and tried to borrow some money, some cash, in return of selling some assets. And all the assets that they had, the collateral was mortgage-backed securities. They were all built up with all sorts of ninja mortgages back then, and nobody was able to buy that security and lend them any cash. That pushed them into the liquidity crisis, and one big bank like Lehman Brothers run out of cash, then all the other banks are also going to face similar situation, because when you have a situation where nobody's trusting anybody's collateral, then everybody's trying to hold on to their cash in a case where when they think maybe I will be in a situation where I try to borrow some cash in the market and I may not be able to get that cash because nobody's trusting my collateral. So that's exactly what happened in 2008. Nobody was accepting the collateral because they think the collateral doesn't worth much, it's garbage, and nobody was able to lend money. That created a liquidity crisis across the financial world and completely collapsed the entire monetary system. And then Federal Reserve jumped in and they bailed out all these big banks using taxpayers' money, billions of trillions of dollars of taxpayers' money to bail these banks out. How do you feel about this? So you, as a hard-working American or European or Canadian, when you hear about these big failures of central banks in their monetary policy, how do you feel about that they get away with that and they even get bailed out by taxpayers' money? You don't get a dime in order to recover your financial losses. How do you feel about that? Let me know, put your comments down below and let me know what you think. And since then, this thing called quantitative easing was started. Right? They invented this whole phenomena of printing money out of thin air. If you ask any veteran economist, they will tell you that they have never heard of this QE thing in their education. It's all made up in the last 20 years, right? It's all made up by these central bankers. And in 2019, we also saw a similar event happen. So in 2019 September, we saw a spike in the repo market rates, and that happened as a result of the same issue, the liquidity crisis. The banks were trying to borrow some money and they were not able to exchange their collateral and get their hands on the cash. As a result, the repo rate spiked up and that caused a liquidity crisis again. And then Federal Reserve also jumped in to start QE. So this was done way before we even know pandemic as a word. So way before March 2020, this already happened, and Federal Reserve and other central banks had their hands on deck in order to start QE and pumping money into the system to avoid another financial crisis. Now you know that how these repo markets and reverse repo market works. So it's all about exchanging collateral with cash. If you have good collateral, you can get some cash. But there might be a situation where you don't have enough cash in the system at all, regardless how much collateral you have and how good quality collateral you have. If you don't have the liquidity in the system, it can run into a liquidity crisis and can collapse the entire financial system. People are comparing today's time of slow housing and slow stock market valuation compared to 2008, and you know that now that this is not exactly the same. Back then it was a liquidity crisis that collapsed the entire financial system, and then as a result of that, the housing collapsed, the stock market collapsed, right? As a byproduct of that, what we're seeing right now is the hawkish tone from the central bankers. They haven't done anything yet. They only slightly moved the interest rate and start doing the tightening. The market is overreacting because the system is already too leveraged. The system has already taken a lot of debt. The debt servicing cost is already too expensive. So even if you slightly increase the interest rate, it will have a major impact in terms of debt servicing cost across the board, not only the household, but also the corporate and the government debt as well. So this is where we're seeing the market is overreacting because of the hawkish tone from the central bankers. And in my opinion, they will continue to raise interest rate and continue their narrative to be hawkish because they want to control inflation. Inflation is still very high. The only way they can kill inflation is by killing the aggregate demand. And the way to kill aggregate demand is increasing the interest rate. But they will stop this at a point where they will break something. And one thing that will be broken is one of those big banks who run into liquidity crisis, and that's where the alarms go off and the financial system is going to be collapsed. And this is where the central bankers again jump in and start reducing the rates, start the QE engine, and start pumping the liquidity into the system. So I think that's where we will see they will reverse their course, but I think we are not there yet because they don't care about your housing, they don't care about your stock portfolio, they don't care about your crypto portfolio. All they care about the banking system, the global monetary system, and that has to be protected at all cost. Hope this is helpful. Let me know what you think about it. If you like it, give me a thumbs up and hit subscribe, and I'll see you in my next week video. Take care.